Earlier this year, Europe and the United States were hours away from a trade war. The White House threatened to impose a 25% tariff on the European Union. Ready to launch. Then, it vanished. Some pointed to NATO, to a quiet strategic concession on Greenland. But something else surfaced. Something quieter and far more lethal. Europe threatened to cut U.S. banks off from European clearinghouses. They are not banks, not assets. They have no customers, no branches. In reality, clearinghouses are super casinos for finance. The players aren't ordinary people. They're banks and financial institutions. The stakes are in the trillions. A single bank's win or loss in one day can exceed years of lending profits. Clearinghouses decide who gets a seat at the table, who wins and who loses, and when the money settles. The returns from financial speculation are so enormous and so fast that, even for institutions managing trillions in capital, this has become the core engine of profits. So they used to bet against each other privately, keeping informal ledgers and settling every few months with no minimum margin requirement. The problem? Bank A doesn't know how risky Bank B really is. Bank B doesn't know how much Bank A owes to others. If either party delays settlement or goes bankrupt, the other is left holding the bag. The real danger? These bets don't just use their own money, they borrow and leverage 10 times, 20 times, even more. Now imagine this happening across tens of thousands of banks. The accumulated risk is staggering. One failure can trigger a chain of collapses. This was one of the causes of the 2008 financial crisis. After 2008, Europe and the United States banned private bilateral bets between banks. Now everything must go through clearinghouses, which set up the games, audit the risks, referee the outcomes, and settle the money. So how does a clearinghouse actually work? Let's use an example. Two institutions betting on whether Treasury bond futures will rise or fall. Fund A bets Treasuries will rise. Bank B bets they'll fall. The clearinghouse is the casino, the referee, and the enforcer. The bet, Treasury futures worth $10 million. The rule is simple. Both put money on the table, a deposit, technically called margin. A posts $1 million in margin. B posts $1 million. That's 10% of $10 million, for example. This margin can be cash or government bonds, any asset the clearinghouse can accept in value. If prices rise, B pays A. If prices fall, A pays B. No physical bonds. Just who pays who. They both face the clearinghouse. It's not two people gambling anymore. It's a system-level game. The clearinghouse settles the score every day. If treasuries rise 5%, A wins $500,000, B loses $500,000. The clearinghouse pulls the money from B's account and transfers it to A. Immediately, not at the end, every single day. Daily settlement is what prevents small losses from becoming system-wide blowups. If A wins $500,000, settled the same day, A's margin becomes $1.5 million. This means A can now bet more. Originally, it could only bet $10 million. Now it can bet $15 million in total. That's leverage. Winnings immediately become chips for the next round. If treasuries rise another 5% the next day, A wins $750,000. The margin becomes $2.25 million. The total bet size can expand to $22.5 million. Either scale existing bets or bring in new opponent D, splitting into multiple simultaneous games. But if A keeps losing to B, the margin shrinks below minimum requirements. The clearinghouse gives A final deadline, a few hours, maybe until the end of the day, to add cash or collateral. If A doesn't add funds, what happens? The clearinghouse doesn't negotiate. It immediately kicks A out. This is called forced liquidation. Then the clearinghouse settles accounts using A's margin. It covers any losses the clearing system has already absorbed, pays the winner, and, if anything is left, may return it to A. Usually nothing remains. Two-person betting is only a simplified model. In reality, future speculation operates as a system-level game, with tens of thousands of participants trading simultaneously, and the clearinghouse controls the power switch. Beyond futures on individual commodities, banks also take positions in a wide range of interbank derivatives. Interest rate swaps, wagers on the future path of interest rates, credit default swaps, wagers on which borrowers will default, FX swaps, wagers on exchange rates and short-term dollar funding conditions, as well as equity index derivatives and treasury derivatives, and much more. This structure allows leverage and liquidity to scale far faster than traditional bank lending. Profits compound in days, not years. Most cross-border clearing runs through Europe. The United States dominates its own domestic clearing. If U.S. banks are cut off from European clearinghouses, thousands of institutions instantly lose the ability to compound profits through leverage. No clearing means no margin trading. No margin means no scaling. No scaling means finance returns to slow, old-fashioned banking, from high-speed finance back to walking. Modern finance is no longer built only on lending. It is also built on clearing. And that is the weapon Europe aimed at the United States. One that never made the headlines, but stopped a trade war in its tracks. Thanks for watching. This is the Fiscal Ledger, decoding the systems we still live under. The modern world wasn't born in a moment. It was engineered over centuries by capital, law, and design. From medieval credit to modern markets, Europe and North America wrote the operating code of power, and we're still running on it.